Where else can you leverage like this on your terms? Hello and welcome to the Durham Talents channel. My name is Jesse Durham and today's subject is going to be leverage. It can either work for you or against you. Now leverage is simply, if I take a drumstick here from my table to show the means of mechanical advantage of a lever. So leverage is just being able to put things to your advantage. Now mechanically, this has been an interesting conversation with my sons that my wife and I homeschool, because we've had opportunities outdoors on our property, just doing things around the house here, to show them how with a smaller size that they could put things to their favor to accomplish more rather than having things be outweighed against them. So being able to leverage in the context of what it means to practice the infinite banking concept could bring us to money. You know, there are a couple of ways to go about earning money. One is to use people, whether that's you yourself or if you're a business owner, like I know a lot of our clients are. If you're employing someone else, you're able to leverage their time, their skills, their experience, and you as a team can accomplish more, of course, together than perhaps an individual by themselves. But regardless, whether you're an employee, whether you're a business owner, whether you're an investor, you can leverage people. You can leverage yourself or others to be able to earn. Now also, you can use money as a lever. You can use money to make more money. So there are those two ways to be able to earn. I would say that regardless of whether we're talking about an employee or a self-employed person, small business owner, big business owner, an investor, no matter which quadrant, according to Robert Kiyosaki, which cash flow quadrant you find yourself in, recognizing that either people or money can be leveraged to earn more money, that leverage is better than liquidation. Now, liquidation is touted a lot in different areas. Let's take real estate, for example, right now. In my area of the country, here in North Carolina, real estate has been going for more than market value for some time now, for some months now. The price has been high for what had not been quite so expensive real estate, just for example. And if you're a seller, that's a great situation to be in, because there you find yourself with the opportunity to be able to sell a home if you're in the market to be selling a home. And let me interject a quick point here also. Something can be said to have a particular value, but until you do liquidate it or leverage it, whichever you go with, it's really just pie in the sky. It's really just a paper value. Something only has a real value based off of the time that it is liquidated or leveraged. Because again, much like I'm saying, a home may sell now. You may be able to liquidate a home now for more than you could have 6 months ago, 12 months ago. And who knows what it looks like in the future. So the timing of leverage or liquidation is very, very crucial. But again, you could sell a home now, hopefully for a profit. You can realize the equity in that home by selling it. But let's also compare that. And there are other variables to look at there. There are the tax implications to consider, and those are not slight ones to consider. What does it mean if you sell a home even if at a profit? Doesn't that also mean that you'll pay more taxes than you would have if... And I'm not saying sell anything for less than you can get for it. That doesn't make sense. Earn what you can for whatever it is that you may want to sell. But also recognize that taxes should be addressed. Then you have to think about ownership. Well, if you sell a home, you're not the owner of it anymore. And again, I'm not saying don't sell a home because you won't be the owner. I'm just asking us to consider these different factors. And we're going to see here in a minute how that relates to the infinite banking concept. So yes, ownership would then transfer to someone else. So there are these factors, these considerations to look at. Now, look at leveraging a home. Can you leverage real estate? So yes, you could take that same single family dwelling. It would be at the discretion of a commercial bank, let's say, according to their terms and conditions, with that house being collateralized now. That house would be in the balance, more than likely there. So you could retain ownership, and you could also leverage the equity of that single family dwelling, but it would be at the terms and conditions of someone else. So what I'm saying is, regardless of whether you actively pursue liquidating assets or leveraging assets, I think there's an argument to be made where leverage could be better than liquidation. So you could keep the house, you still maintain ownership, but you leverage the equity to your advantage, to your benefit in some form or fashion, if that's what you choose to be able to do. Now, that begs the question then, how can we take depreciating dollars, and if you wonder whether we have depreciating money right now, just consider what a Coca-Cola would cost 50 years ago, 20 years ago, last year to this year, what may it cost in the future. I believe we can arrive at discerning that our dollars are depreciating. So that begs the question then, where can you put depreciating dollars that will procure for you an appreciating asset? Great question, right? I'm glad you asked. I'd be happy to answer that. A whole life policy, properly structured with a mutual company that pays a dividend. So a whole life policy structured for the infinite banking concept is an appreciating asset, and you fund it with depreciating dollars. So the premiums that are paid, whether that's monthly or quarterly or semi-annually or annually, because you have that discretion as the owner of the policy, those premiums are paid with depreciating dollars, but the asset itself, the whole life policy itself, is an appreciating asset, meaning that it has an ever-growing base. The death benefit grows. The paid-up additions from a dividend would add to the death benefit, and that therefore means that you also have a cash value that is ever increasing. So from the time that a policy goes in force until its maturation, every day, weekends, holidays, recessions, depressions, world wars, government shutdowns, pandemics, whatever the case may be, that is going to increase. So you have an ever increasing base. So you've been able to turn those depreciating dollars and leverage them to procure an appreciating asset for yourself. And there's guaranteed growth in that contract. I mean, we got statements here recently, and I know that the dividend, and I'm telling you that the dividend is a non-guaranteed part of a policy, and yet we've gotten a dividend every year that we've owned our policies, because we own policies with companies that have paid dividends for well over 100 years. And I'm not saying that I'm married to any one particular policy, or company rather. I own multiple policies with multiple companies. I have more policies in underwriting right now, actually. And yet, that dividend bought a multiple of itself, because I elected for my dividend to buy paid up additional insurance. And those dividends bought 5 times the amount that they are in a future death benefit. Over 5 times the amount of death benefit was bought by the dividend from this year. Just, it's exciting stuff is what I'm saying. So those depreciating dollars can be procuring appreciating assets. That's a beautiful example of leverage right there. And it allows for the same dollars then to be able to accomplish multiple jobs. So when you take a dollar and you have that be a premium to a policy that you own and control, it converts into death benefit, cash value, everything that's in the contract of the policy. Well, you can borrow against, for your need for finance, to be able to satisfy whatever it is that you're already doing. Keep doing whatever it is you're already doing, but by adding that one step of paying a premium into a policy that you own and control first, you can leverage the cash value in that policy for financing whatever it is that you're going to be doing, anything, taking vacations, buying vehicles, paying for college, acquiring business equipment, whatever the case may be. But that same dollar has now accomplished more than one job. And when you understand banking, when you dive in on Nelson's book and this channel and realize what commercial banks are doing, and that we're just simply wanting to do the same thing for ourselves, but with an entity that we own and control, a system that we own and control, then we want to be able to turn those dollars over and over and over again. The three rules of banking are pay yourselves first, pay yourselves with interest, and recapture that money. So you can use those same dollars over and over again. Now also, remember that this policy is perfectly collateralized. So in contrast with the house that we use, saying, yes, you could sell a house, you could liquidate it to be able to realize a gain, to be able to realize capital, or you could leverage that with a home equity line of credit, let's say with a bank, a commercial bank, and that would be at their terms and conditions, and you paying them interest, but you could still do it. Well, see, accessing capital from your policy means that you are leveraging the cash value of your policy to acquire a policy loan for whatever it is that you want to do. And the only collateral in that entire relationship is the policy itself. The death benefit of the policy is represented net today in the cash value. So you can access the capital in the policy, the equity in the policy. Follow what I'm saying here. And the collateral is the death benefit. So that is a perfectly collateralized, appreciating asset. Now, I think that there are some factors to recollect here, and not the least of which is what Nash encourages us to remember. It's page 19 about the First National Bank of Midland, Texas, that the owners had been making loans to themselves without repaying and without paying interest either. And even a business as good as a bank can be run into the ground, ruined, by not being an honest banker. So I believe that, especially in tumultuous times, we do live in a boom-bust cycle. There are things that are outside of our control. But by maintaining control over what we can, by not abdicating the banking function, for example, to someone else, we can put ourselves in a position of having capital, of having access, guaranteed, contractual access to capital. We could be putting depreciating dollars into an appreciating asset where compounding continues to take place and to take place and to take place even when we access the capital that's in our policy. So we don't have to put ourselves in a position like those owners of the commercial bank in Midland, Texas, where we are undercapitalized or where we are over leveraged in speculative endeavors. So what I'm saying is just because you can access all of the capital, all of the equity in your policy, doesn't mean that you may want to. Now, I'm not telling you what to do with your policy. I'm not telling you what to do with your money. But I'm saying there's something prudent to be recognized about having capital. Not having leveraged all of it, but actually maintaining a buffer, if you will. Maintaining funds that can be accessible in the event of necessity. Okay? You don't have to leverage every single penny that you have in capital. You can maintain an appropriate relationship, like Nash describes, between the capital that you have, the deposits that you're making, meaning premium payments to your policy, and then also loans that you make from your policy. So you, as the practitioner, can maintain a healthy relationship between the capital that you have, between the deposits that you make, meaning the premiums that you pay to your policy, And then also the loans that you make to yourself and that you repay and repay with interest and recapture back into your system. Okay, those three are distinct, they're different, and they're important to keep in a balanced relationship. And who should be dictating that? You. But here's the education, here's the information on consider that. Consider capital separate from the deposit, separate from the premiums that you pay to your policy, separate from the loans that you make for the things that you're going to finance anyway. But ultimately, pay yourself first, pay yourself with interest, and recapture the money so that you don't have to worry about having stolen the peas and being caught in a moment where you need access to capital but don't have it because you either practice poor banking, you weren't an honest banker, or that you were an honest banker but you just over leveraged everything and were caught in a moment without enough capital to maintain a healthy relationship due to something outside of your control. Getting your industry shut down, having government shutdowns, pandemics, or you lose a job, or just whatever happens, being in a position of not having capital and the access to it outside of everything that you may have leveraged. You don't have to have every red penny leveraged in the cars that you're financing for yourself. Even if you're being an honest banker is what I'm saying. Even if you're being an honest banker, you don't have to have every single dollar leveraged somewhere. Please don't discern what I'm saying here to mean that I'm saying don't do anything with your money. I'm saying keep doing what you're already doing or that you want to do, but add the step of course, pay policy premiums into a policy that you want to control. Access the capital in that policy for whatever it is that you want to be able to do, and that could be including real estate investment, for example. You could pay policy premiums, access the capital in that policy to go out and buy or put a down payment on or what have you for a piece of real estate, make a real estate investment. Again, I'm not saying make real estate investment, it's just an example. But you could procure a real estate investment for yourself, earn from that real estate investment. Well, where are you going to put that? Well, back into the policy. And you can get that to a point where you have enough capital, you can't put any more into that policy. That may lead you to looking at adding to your system. So that's a good point there that, one way to find out when you need another policy, when it's time for you to be able to add to your system, is that you just have capital somewhere else other than a privatized banking system, a part of your privatized banking system, a policy that you own and control that gives you a death benefit and a hedge against inflation and litigation and guaranteed growth and all these other attributes that you would want your capital to be capitalizing. So again, you could turn your dollars over time and time again for the things that you're already doing or that you want to be able to do, and then you will just naturally build out this privatized banking system to accommodate all of your needs of finance in your financial footprint. I mean, where else can you leverage on your terms like what we've described here, being able to take, your money and fund a policy that you own and control, then access the capital that's in that policy, go out and procure a real estate investment for yourself, and then of course you'd have the opportunity perhaps as well to be able to do some conventional leveraging where you have a home equity line of credit on that real estate investment to be able to do more of the real estate investing or fund the policy back, recapture the money back into the policy that you use to acquire the real estate in the first place, or to pay back the home equity line of credit from the earnings. So again, we're seeing the infinite amount of leveraging that you can do here. And don't misunderstand me. Nash came about conceiving the idea of the infinite banking concept by being over leveraged with $500,000 in real estate investments at 23% interest, I believe it was. That's almost $70,000 a year that he was looking to pay in interest that he did not anticipate. That was outside of his control. So I'm not saying over leverage yourself. I'm not saying use other people's money, don't use other people's money. Figure that out for yourself. But I am saying you can be your own banker. You can account for your need for finance. You can account for the banking function in your life, so that if you do decide to use other people's money or leverage real estate or anything else that you want to do, that you have the capital somewhere that you want to control to be able to offset that. That you account for the banking function in your life, and that you control the terms and conditions that you agree upon. That you be the one in that position of power and authority and ability for yourself. So that's leverage. Let me know in the comments section some way that you're using leverage in your life right now. I think that would be an interesting thing to hear. And if you would like to have a conversation about how you can implement the infinite banking concept and leverage your dollars for you, then you can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.